Hello, this brief video covers the Appendix 2B content on the predetermined overhead rate and capacity. So the learning objective here was to understand the implications of basing the predetermined overhead rate on activity levels at capacity rather than on estimated activity for a particular period. So if you think back to earlier in Chapter 2, we talked about the determination of these predetermined overhead rates based on the expected or budgeted level of allocation-based activity for the period. So if a firm was using direct labor hours as that overhead allocation base, they would come up with this estimate of total expected labor hours for the period for that denominator piece in that calculation. Now, another method that does exist in practice, but would be used for internal management purposes only, would instead base that denominator volume on the estimated total amount of the allocation base at full capacity. In other words, the total amount that the firm could possibly use up, if you will, or have available in terms of that allocation base. So if we're talking about labor hours, we're saying the total number of labor hours available for the workforce as a whole based on full capacity, if we ran to full capacity throughout the whole period. So for the rest of this appendix content, we're going to make two quick assumptions just to simplify things. We're going to assume first that all manufacturing overhead costs are fixed. Now obviously in practice that's pretty much never true, but again it just helps us kind of think about some of these things with regard to capacity. And then second, that the estimated or budgeted fixed overhead at the beginning of the period 100% equals the actual fixed overhead at the end of the period. So we don't have any kind of under or over applied overhead. So there are two potential problems with using what we call this traditional absorption approach to costing from a managerial accounting position. First, if the predetermined overhead rates are based on budgeted activity and overhead costs include significant fixed costs, then the unit product costs are going to fluctuate or differ or vary depending on our budgeted or expected level of activity for the period. And what we're really kind of saying there is that our unit product costs are going to differ just artificially based on our differing levels of activity for a particular period. So if we produced 5,000 units one period and 10,000 units the next, the unit product cost is going to be very different between those periods, regardless of the fact that, or irrespective to the fact that our total costs really haven't changed. So we're just kind of spreading the fixed cost over more and more units, which distorts our unit product cost view. Second, it charges products for resources that they don't use. So when the fixed cost of this capacity, again operating kind of full speed if you will, or full bore, are spread out over the estimated activity, then the units that end up being produced have to shoulder this extra burden of the cost of unused capacity. Again, we're just sort of artificially changing or distorting this unit product cost just based on our actual level of activity versus our kind of full bore or full volume activity. So the limitations of traditional absorption costing can be overcome, at least potentially, by basing overhead rates on the estimated total amount of that allocation base at full capacity rather than the estimated total units in that allocation base as we talked about earlier in Chapter 2. So let's look at an example here. So let's say that Maximum Ink leases a piece of equipment for $100,000 a year, and that's sort of the only overhead cost in this scenario. If run at full capacity, the machine can produce 50,000 units a year. However, the company estimates that 40,000 units will be produced and sold in the upcoming year or next year. Now, the predetermined overhead rate based on the units produced and sold, or that estimated activity if we think about the beginning of the period view, would be, as we calculate here, $100,000 divided by the 40,000 units produced, or $250 per unit. Now, the predetermined overhead rate, if based on capacity, full capacity, would be the $100,000 lease divided by 50,000 units a year, or $2 per unit. So as we spoke about a couple minutes ago, really we're changing artificially in a way the unit product cost just because of this difference or this change in expected volume of production. So carrying this forward here, let's calculate the cost of this unused capacity, sort of that volume we're not using or we're not executing, given what's shown here in the box. So we'll say this cost of unused capacity is going to be equal to the amount of the allocation base at full capacity minus the actual or expected amount of the allocation base times that predetermined overhead rate. So in this particular example, we're saying it's the 50,000 units that could be made at full capacity minus the 40,000 units we were actually going to make, so a difference of 10,000 units, times that $2 per unit predetermined overhead rate based on full capacity for a total of $20,000. Now what we're saying here, just to kind of sidebar for a second, is that if we based the predetermined overhead rate on expected activity rather than full capacity, this $20,000, this burden, would be borne by the 40,000 units that we actually made. So that was the 50-cent difference in unit product cost times the 40,000 units. Okay, so this cost of unused capacity, again, we're going to quantify it as that difference in amount of the allocation base at a capacity minus the actual amount of the allocation base to be used times that predetermined overhead rate based on capacity. So $20,000 again here for Maximum Inc. Now this cost of unused capacity, since we are doing it specifically so that the units produced don't have to bear this extra cost, is going to be treated as an other expense, just like selling and admin expenses on an internal use income statement. So important point here, we can't use this for external financial reporting purposes. We have to stick to our traditional absorption costing approach. But from an internal standpoint, it can be very helpful for managers to know that we have these costs of unused capacity. So yeah, to sort of reiterate here, rather than treating this cost of unused capacity as a product cost, as we do under our traditional absorption approach, we're treating it really as a period expense being reported below the line. And so the need to effectively manage capacity is really highlighted for the company's managers, or it should be. Right? If they're looking at these internal income statements and seeing these big costs of unused capacity, they should be starting to ask questions about how we can potentially use that capacity a little more efficiently. So they should potentially be responding by looking for new opportunities that would consume that capacity and or cutting costs or shrinking the amount of available capacity out to work in process, finished goods, and or cost of goods sold. So depending on the type of firm we're talking about here, how they're currently operating, their proportion of fixed and variable costs, and a whole bunch of other factors, they may try to use up that capacity, or they may try to shrink that capacity, if possible. So let's wrap this up here with one question. So when the fixed costs of capacity are spread over the estimated activity of the period, rather than the level of activity at capacity, the units that are produced must shoulder or bear the costs of unused capacity. Is that true or false? Think about it for a second, pause this, and then I'll have the answer right away. So that is true. Therefore, that's why it may be most appropriate to determine the cost of unused capacity, highlighted on that internal income statement, so we can make some decisions to change that going forward, either by using up that capacity or potentially shrinking it if possible. That's it for the Appendix 2B content. Feel free to back up and review any piece you wish, and let me know if you have any questions.